evening, everyone. So since we have a shortage of time and the lady literally has a flight to catch, so we can't keep, a lady waiting. And anyway, it's ladies first. So we have a very interesting topic, which is navigating valuations across geographies. And we have a very interesting panel, starting with the lady, Laura Raggl. When I first saw it, I thought it was Laura Raggl, because the L and I look very similar, but it's Laura Raggl from Australia. We have Ohira from Japan, who's now made Bangalore his base, from Deloitte. We have Prem, who straddles both the UK and the Indian area. We have Arjun, now based in the Bay Area, but our very own Cochin boy, who's made it big. And then we have Jose, who's from Philadelphia and here. So we have a very interesting panel, but I had a certain flow. We have to disrupt that flow because of Laura's Dubai flight. So Laura, straight off, you are investing as an angel investor directly as a small fund up to 100,000 euros in startups directly. You also invest through as an LP into certain funds. What is the difference that you see between startups, say, in Austria, Europe, etc., and startups here? And what exactly do you do in order to manage these differences?
Yeah, really happy to be here, and also thanks for changing the order of the panel now in order for me to have the opportunity to talk and tell you more what's going on in Europe. So we actually invest directly in startups in Europe, and we invest in VC funds outside of Europe, and we also invested in 2 Indian VC funds, just because we see really good return opportunities here in India. And I'm also happy to tell you more about this, which also comes back to the topic of today, which is about different valuations. I think India, as you know, has really high growth in terms of GPT, way higher if you compare it to Europe. And this also relates, of course, to the returns you can make in venture capital. So for us, therefore, it's really interesting to invest in an emerging country, because we think there's just a way higher probability of having good returns here. And we also see that across the funds we're investing in. In Europe, we have a really different state of the startup ecosystem. The European startup ecosystem is around 20 years old now. So there's certain standards which have emerged, and it also got super competitive. So actually for us, if we want to invest in a startup, it's more that we need to pitch to a founder why we are the right investor. And I think this is still really it's really different than in India, where I think there's still a lot of power at the investors, and there's still a lot of negotiation power, which is definitely less. And when the negotiation power of the investor gets less, usually the valuations get higher. And this is exactly what happened, for example, in the US, where startup founders have way higher valuations. And this also happened in Europe, where like an average pre-seed rounds happen around 3 to 5 million valuation in terms of company value. And this goes on across the funding rounds. And in India, you still have that negotiation power. You have the opportunity as an investor to also maybe have further rights, and it's just a completely different dynamics in terms of what can a founder do and what can an investor do. I think in Europe, we got to a point where it's quite equal in terms of rights, and we as an investor, we always want to have the best to the founders. So it's really important for us that founders have more than 50% ownership of their company until they get to a Series A round, for example. So we try to align a lot also with our co-investors on the common goal of making the company successful long-term. It's a 5 to 10 years game in the end, and you need to have sufficient equity in order to have the next investors coming in. So this is also the point where we maximize on, because equity is the only currency of a startup in the end, and you need to be really careful with how you spend your equity. And maybe there I could align some differences between India and Europe there.
I'll ask you one question before I let you go, because I think the flight will not wait for you, which is, what are the cultural differences that you see in startup founders and entrepreneurs in India versus those in Europe, and what advice would you give to anybody wanting to look at funds or moving to Europe?
I think the motivation is completely different. A European founder can also be a kind of lifestyle founder. Sometimes it's just kind of cool to be a founder. You try for a couple of years, and if you fail, it doesn't matter so much. And what I see in India and what I really like more is that drive. You really need to succeed. It will change your life if you succeed. And entrepreneurship is really a way of make your life way better. And I think this is really different when it comes to the motivation. And I see so many founders here in India not just doing it once. doing it twice or doing it a third time. And if a European founder is doing it for a second time, we always ask the question, why are you doing it? Are they enough motivated? Don't they have made enough money already? Are they still have the drive? And we don't ask that question to Indian founders because we just see there is such a intrinsic motivation of succeeding, not just one time, succeeding multiple times. And again, this motivation comes back also to the returns you can expect as an investor.
Laura, I think we'll let you go, but before that, I think we'll give you a memento so that you can be on your way. I'm sure otherwise you'll miss your flight, okay? So I'm so sorry, but we are doing things a little ulta-pulta.
Thank you, Mr. Chandu Nair, for being such a sport. I request you to present the memento to Ms. Laura Raggl. Can we have the memento, please? We also request all the panelists to please step up and have the group photograph taken before Ms. Laura leaves.
Yeah, let's stay in touch.
Please join for a group photograph.
Thank you. Let's stay in touch. Thank you.
Ladies and gentlemen, this is how we innovate when there is a disruption. We see it live on stage now. Thank you for being such sport. Back to you, Mr. Nair.
So I think Laura provided us a great segue into the original format, which is that Indian founders have tremendous drive. So much so that they don't want to stop with just the first one. You know, it's like, I think some certain people in the US getting married multiple times. And they call it serial monogamy, okay? So we have such a person in Arjun here who started...
Not the marriage side, just the startup side.
Not yet. He's in the Bay Area, so the culture might influence him too. So Arjun here started a company called Profounders way back in 2014. 2012, and he went searching for funding in 2013-14 and struggled. He sold that company, then he sold a second company to the publicly listed Zoom Info. He's now on his third company, but he's also an investor in his own right. And he's also created a network which also invests into startups. Arjun, what are the things, and he's a Cochin boy, QSAT boy, etc. So from what you were in 2012, 12 years later, what are the changes that you have seen, as a, struggling entrepreneur looking to raise funds from stingy investors in India to now being an investor yourself?
Thanks for having me here. It's a great opportunity. It was very different, right? I was one of the first generation entrepreneurs that started in Kerala, at least, and back in the day, India was still very early. I have always been a B2B person than a B2C guy. So what that meant is the investors who are looking to invest in B2B at that point in time was not that high. And the B2B side was still kind of a copycat mode where there is something working in the US. You are kind of copying that software in India and selling it for cheap. Right? That was kind of the model that was happening in India generally. So I've seen several investors really struggling to put a value to what we do. We were in, at that point, people called as business analytics or data analytics. We were really in the sales intelligence space, but sales intelligence as a space evolved only after 2014. We were doing it in 2013. So kind of, early to the world from that standpoint. Luckily for me, Vinod here was one of my investors who understood what B2B was because of his background, and he put in 25 lakhs back in the day. Thank you. So that was a big difference. The second big difference was the exposure that I had, right? I got 65 no's when I was raising my first round before I got my first yes. And I was raising $350,000, right? Not much. But the problem was I did not know that there were things called seed funds and VC, Series A, Series B funds. I was going and talking to all kinds of people trying to, in the hopes of, and they would give me first meeting, second meeting, partner meeting, and they'll be like, let's talk in 3 to 4 months. And I'm the idiot who did not understand what that meant, right? It just meant no in a nice way. The reason was that I should have spoken to either angels or people who were willing to write small checks of 100K or 150K, not go and talk to like a VC who was Series A. So my exposure level was bad. But now, thanks to events like Hurdle or other events and things that have evolved in the ecosystem, I think that the exposure of people have gone up quite a bit. And the third thing that I would say is the quality of founders generally, it has gone up. And as a result, I think investors are way more susceptible and they want to actually look at Kerala startups and generally Indian startups more. So the availability of capital has gone up, the early risk appetite in investors, although it is nowhere comparable to a place like Bay Area, for example. Even valuations is very, very, very different. Here a seed round is anywhere between, let's say 200K to $1 million is a seed round. In US a seed round is anywhere between 2 million to like a 6 million, right? In Bay Area specifically. So there is, and for people to understand valuation, since we are talking valuation, you have to say that the valuation is 5 times the, 4 to 5 times the round that you are raising. Which means if somebody is raising 500K, your valuation is 2 million to 2.5 million. If you are raising 6 million, the valuation is about 30 million to 40 million. So that's the rough thing, right? There's a big difference in valuation still between Bay Area and India. Rest of US is closer to India, not close, but a little bit. So there are still differences, but the world has improved quite a bit here.
Prem, you have, okay, disclosure, I am an investor in Prem's funds in the UK. So let it be known that we have an older relationship. But Prem, you have had a UK fund, you have invested in founders and entrepreneurs in the UK, plus you've got funds in India and you're investing in Indian startups. Now, one of the conversations we've had is you find way more entrepreneurs in the UK and way more founders in India. Can you explain this nuance, to the audience here? What do you mean by that, and how does it impact your investment decisions as also the valuation?
Thanks, Chandu, but you just let out the cat out of the bag, which is saying it is an older conversation. Didn't know what you meant by that, as long as you didn't reveal how old it was. Nevertheless, so yes, we've had multiple interesting conversations about this space or how founders react or how founders adapt between UK and India. So when I meant difference between a founder and an entrepreneur, a founder typically knows what they have to do at a given point in time. An entrepreneur is talking about what they have to do today and what they have to do tomorrow and 3 years from now, and they have to be in a position to be able to adapt. So that is the most important bit from transition from being a founder to an entrepreneur. Let me give an example. We invested in a company in India, in Roorkela. Very interesting company in underwater drone surveillance. They were one of the 3 companies in the entire India doing that, and founders are very, very passionate about what the product that we're doing. When we met them first, they were very technically savvy. And they're doing phenomenal work, getting clients left, right, and center, from Tata Steel to Shell, through to Indian Railways, etc., etc. But what happened was, when we actually interacted with them over a 2 to 3 month process, 2 founders, we told them, guys, you both are actually technically qualified. But the transition from being a technical person to a CEO of a company is very different. Now, if you do that, it's not that you cannot do that. But if you do that, it is at the cost of you trying to kind of shy away from what you're doing today, which you're best at. And that's what the company needs. So we said, eventually, in the next 6 months to a year, we think you will need a CEO to actually kind of run the business, where both of you become CTOs or CPOs in this company. Very candidly, it was not a great conversation, and there was a lot of fight going on in a very constructive way. And we ended up saying that, if after 18 months or so, if you're going to have, or 2 years or so, if you're going to have the same thought process, we'll respect you, because by the time you would have exhibited your commercial astute and how you're going to distribute your efforts between you both. 18 months came in, both the founders wanted to called us again, and they said, you know what, I think you were right. We are qualified in terms of what we are doing, in terms of technology. We believe commercial expansion and other things is not our forte. It is actually disrupting our thinking process and our mind space. So I think you should help us find us right CEO. That is when the 2 guys actually moved from being a founder to an entrepreneur. Because an entrepreneur puts the company first. A founder puts his or her title first. So this is the difference that we find between India and the UK. It's to say that Indian founders are becoming entrepreneurs. India itself is a startup in the startup ecosystem. We're seeing that evolution happening, but there's more room to cover.
Thank you. And with that, we'll move to Ohira, who is part of a very interesting outfit. You know, we have, if you look at the spread of people, we had people from Austria in the angel ecosystem cutting checks. We have a parallel entrepreneur doing 3 different things right now, apart from being a serial entrepreneur. We have Prem, who straddles the UK, both being an enabler as also investor. And then we have Jose, who was earlier writing smaller checks and last year created a fund. Okay, and he will tell you a little later. I want to ask him about that. Now, coming to Ohira of Deloitte Tohmatsu, I have to read it out here, Venture Support. At Deloitte Tohmatsu Venture Support, we support, connect and cooperate with startups and corporations in order to transform bold ideas into tangible, innovative solutions. We have supported over 3,000 promising startups. Has also assisted hundreds of clients to implement open innovation programs. Now, Japan, 0% interest till recently, correct?
That's correct.
So any return above zero.
India is a 7% over, right?
Sorry?
India is a 7% over, right?
So I'm just saying, so, you know, and Japan is going through a transition, socially, economically, etc. So just explain to us, you know, what made you, one, decide to do this in Japan, number one. Number two, what exactly are you hoping to achieve in India? And what has been your experience over the last 6 years coming to India?
Okay, thank you, Chandu. So we are supporting the many startups in Japan first. And so now I'm focusing on the India startups. So my mission is India startup connecting to the Japanese large corporation and the Japanese investor also. So you mentioned that's correct. Japanese financial interest is 0.25%, very still low. That's a very rare case in the world. So that's why the very aggressive for the investor is still aggressive for the investment to the startups. So in Japan, the investor is not only the independent venture capitals. So corporate venture capital is a very huge amount they have. So we are supporting the investment to the India startups from the Japanese corporate venture capitals. And I forget the second question.
I said, so your experience in India with the startups, you know, when you come from a culture like Japan and you have been coming to India from 2018. So what do you see different from the Japanese startup or the Indian startup, you know?
Okay.
I just wanted to understand that.
Yeah, many point difference. So first, Indian startup guy is very aggressive. Japanese guy is a little bit shy. So yesterday I waiting for some appointment, waiting for the front of these venues. So 5 minutes waiting, 5 people coming. many people coming and so interested for their own businesses. Very good, aggressive. And so Japanese event is sometimes is need to like action to my side. Yeah, that's one case. The second point is very like different for the theory. Like an Indian startup is sometimes using the very huge human powers, like many deliveries, many things is a very huge human power. But in Japan is less human power is a very big trend and cannot remove. So that's very different. So every startup founder is I'm making many meetings. So I learning for the in Japan's standard is very different for the India standard. Basically, start point is very different. Yeah.
Okay, so I just want to ask you, Jose, you know, you've been doing this investing now for more than 10 years, and you've written more than 20 checks and had 4 exits. Okay, and you have started your capital fund. So one of the happy exits must have been yours. Okay. Now, in the last 9 months since you started, you said that you have screened 600 companies, but you invested only in 6 companies. Okay. And, you know, for a lot of the entrepreneurs out there, this 1 in 100 sounds like a terrible number. What is the problem? You know, is it the problem with the kind of startups or founders, or are your standards too tough? What is happening here?
All right, thanks, Chandu. So firstly, we launched in Jan 2023, so it's been close to 2 years now of running the fund, and we've invested in almost 14 companies and about 3 million, which means we probably have looked at definitely over 1,000. I think it's about 1,200 deals that we would have looked at. So in that sense, yeah, about 1%, just about 1%, right? Why is that? Firstly, I mean, startups, it's a numbers game in terms of the probability of success. I think everyone knows that most startups die. And that just is the fact of how this industry works. But for us, we look at the probability of success of every company that is coming to us, right? So there are a lot of factors that go into it. Obviously, we look at the founders, what are they made of, their aptitude, their capabilities, their understanding of the market that they're going after. Do they have what it takes to execute and succeed? But also the market in terms of the opportunity, how big it is. And it's a combination of all these various factors. So you can think of it as if you're cooking a dish, there are all these ingredients that need to come together in a certain way for it to taste good. So similarly, the ones that we are passing on may be lacking a few things that, according to our perspective, is missing. So it's not necessarily that the founder is bad or they don't have what it takes. It's a lot of other things are also involved in terms of timing and external factors like luck as well. So for me to make an investment decision, it has to cross the threshold of where my risk appetite lies and my assessment of the probability of success. And in most of the ones that we are passing on, it's just that either they are too early or we feel, the market is too competitive or some one of the other factors that go into that decision. Yeah.
Okay, now Arjun and Prem, you can also say, and also Mr. Ohira-san, this returns that you get in different geographies. You are in the Bay Area, which is the highest valuation, but also one of the most exciting ecosystems in the world, probably number one. And you've been in UK, which is kind of going through its own churn, right? And you're in Philadelphia, a little more staid, city of brotherly love and all that. But we want to see what kind of returns are you getting in different geographies. So maybe Arjun, you can start off by saying when you started off ProFounders, what were the investor expectations to today? You are writing checks yourself, and what are the kind of expectations that you have both in India and abroad?
Yeah, I'm obviously an angel, so the way in which a fund thinks versus an angel thinks is very different. But from a return standpoint, I don't necessarily think that there is a big difference in the way in which a fund thinks about a return, whether they are in India, UK or US. Because the way a fund thinks is, hey, I'm going to put money in 10 companies, 6 of them are going to go bust, 2 of them are going to return back my money, 1 is going to give me 3x return, and 1 is going to give me the entire fund. So if I have to do the math, typically, on a seed check, you have to do like 100x on a valuation, right? I'm oversimplifying it. If I raise at X dollars in my first round, I have to do 100x of that valuation for that fund to make the full outcome. Because typically a seed fund will take an ownership anywhere between, let's say 13% to 20%. It can be as low as 8%, as high as 25%, but let's say averaging out 13 to 20%. Now if you are at the seed stage, they have to do another 4 rounds. So they will come down to something closer to 4% to 8% after everything. Now you go, exit at, let's say $500 million. They are making 5% of the $500 million, and that has to return the fund, right? And that math kind of holds across everything. In US, you raise your first round and the subsequent rounds at a higher valuation, which means that the expectation is also much higher. US being a bigger market, the outcome can be much higher. Like a Databricks delivered 1000x for the angels, right? Like an Uber gave 2000x for the seed fund. And all of these things and that is the market difference. But in terms of the real financial things, I don't think there is a difference. As an angel, when I invest in companies, it is rare that I will be able to be with a company for the entire ride, because I am getting what, 1%, maybe 0.7% of the company, something like that. And at some point, it may make sense for them to clean up the cap table. could be Series B, Series C. And at that point, if they are offering me an exit at a few X's, 3, 4, 6, 7, I would love to get 100, but I don't think I'm getting 100 on that one. But if they have to clean up the cap table, then I want to be a supportive angel investor, take that money and bow out, would be the way I think about it. But
Good. Prem, I just want to ask you, because you're cutting early stage checks, you're then also having to deal with later stage growth capital, etc. What do you see happening in the UK or India? What typically should one expect as an IRR, given the different geographies? Internal rate of return.
So let me answer that question straight. Fund 1, 28%, Fund 2, 48%, and Fund 3, we are currently running at 84% IRR, right? So that's what we're doing. But the point is, our view is slightly different. Just like Arjun, we are a fund which invests in B2B businesses. If it is a B2B business, and thanks to COVID, the world has become flat. Consumers, which is clients, are willing to pay the premium for high value proposition projects and products. So when we are investing in such companies, whether it is in India, whether it is in the UK, it doesn't really matter to us because we expect these companies to grow global. That is as simple as that. I'll give you a real life example. We invested in a company in our first fund called Switchy, which is just making about £100,000 in revenue. They are a smart thermostat for social housing. UK has got about 5.5 million households in social housing and spread across 150,000 landlords. They save the landlord substantial amount of money and also save fuel poverty. From £100,000 in revenue in 2018, they have now moved to a 20 million sterling revenue as of this year. And at the same time, out of the 150 housing landlords, they work with 130. And as they scale up, they'll comfortably become 100 million sterling ARR, which is about 1,000 crores annual recurring revenue in the next 2 years. And at the same time, they've also expanded into Netherlands. They've also expanded into Australia. So as a B2B business in this space, their expansion is beyond borders. So from our perspective, we focus on those and channelize our energies on those companies which can scale beyond borders. And that's the reason why we're comfortable in a very conservative way, anything about 25% IRR on a year-on-year basis.
Thank you. Ohira-san, what about you and you're the companies that you take money from and put it into startups? What do you tell the Japanese companies? What is the kind of IRR that you kind of tell them to focus on or to target?
Yeah, so he's like IRR is a so amazing percentage. So surprised. And so actually we cannot investment directly, but so we are supporting the many corporate venture capitals. But I would like to explain for the one Japanese startup exit scenes. So in Japanese market, 80% is IPO. So 20% is M&A. So many startups will do the IPO things. So that's why the Tokyo has the Tokyo Exchange market is a so nice market for the IPOs. So they are very aggressive for the startup growing up the IPO periods. So now they're invited to the overseas startups also, the Singapore one and the Taiwanese one. So their Tokyo stock market, they're inviting the overseas startup and the IPO to the Japanese market. Please know that one selection for the IPO markets.
So that's good. I think a lot of Indian companies now who are having Yamaha kind of single dealership stores, many of them can probably look to Japan, and you have Ohira-san to guide you also. Okay, that's on a lighter vein. But you also cut small checks. We've got only a couple of minutes. You also cut small checks. What is your expectation, both as an angel and now as a fund?
So in my angel portfolio, the realized IRR is about 31%. And in the fund, it's obviously still early, but we would be happy if we can get anything north of 25%. Obviously, we want to do better for our investors, which translates to about 3x on a multiple on invested capital basis. So yeah, those are the kind of numbers that we are hoping for. And the reason why we are very selective is also, therefore, we want to make sure that this fund performs, and it's our first fund, so that the traction is there.
Okay, so just to recap, I'm going to ask these gentlemen to give us one line each. Okay, but just to recap, for an investor, typically, especially at an early stage, which most of them are, two things are very important. One is return of capital first, and the second is return on capital. So I think the preposition makes for the proposition, just to give it another. So gentlemen, if you were to give advice to these entrepreneurs here, A, would you tell them to raise money in India or raise money overseas? Which type of companies can raise overseas? And what should they do to make them more valuable for an investor? I'll start with Arjun again.
Yeah, I can give the founder perspective. So the first thing is, take money from where you get it, right? See, you are sitting out of Kerala or Bangalore, you want to raise from the Bay Area, show up on fine day, it's not going to happen. Let's just be honest about it, right? So if you get money from Bay Area, yeah, take it. But get money from where you get it. That's one. Number two, don't worry a lot about the valuation in the first round. Most of you guys are at the seed stage. The first round of valuation is, yes, relevant, but it's not going to define who you are as a company. Like Airbnb, their first round, they diluted a lot. Recent company, Glean, that you might be reading, 4.6 billion latest valuation. They raised $15 million at a 35 million valuation in the first round, right? Which Arvind Jain, Rubrik, he co-founded Rubrik, just went public, and Arvind was a co-founder of Rubrik. Even with all that, he raised 15 on 35, right? Which is pretty high dilution for people who are doing the math. So it does not matter. The first round is not going to define you. As long as you get a good partner in the room, that's very, very critical, because it's like a marriage. It is very difficult to get an investor out of the cap table in the future. So focus on the person, not focus on the exact valuation. Then don't dilute a ton in the first round. Get it. A lot of founders are like, hey, I want to dilute only 5% of the company. Not going to happen, because these guys have to hit their numbers, right? So they have to get a 13% or 15% stake for them to make their math right with their investors. So don't try to get at 5%, 4%, 1%, not going to happen. Be willing to spend somewhere between 13% to 20% in almost every round until you hit a Series A, right? And as long as you don't go beyond like 25, you are fine. Try to keep it at 15 to 18 if you were to ask me. That's all. So these three things: take money when you get it and from where you get it. Take money from the good person. Don't focus on the number. Don't dilute a lot. Your initial dilution is going to be fine. Either you will make it so big that 400 million and 500 million, you lose 100 million, not going to make a big difference, or you are not going to make it, not going to make a difference either way. That's my...
Okay, I'll ask Ohira-san also now to tell us, what do you think, what advice would you give to the young or not so young startups and entrepreneurs?
Yeah, so I have the very big bias. But I'm supporting the many startups. Especially the Japanese in the past. So I'm feeling the leverage is a very big importance. So investor choice is how to collaborate with them, how to support from them. So they're a very important point. Especially in Japan, 80% of budget is from the corporate venture capital, right? So from the startup perspective, need to leverage their powers and their assets. So that's a very important point, yeah.
It's a very good dynamic in Japan. The corporate venture funds are about 80% of the total funds available to startups. Okay, Jose.
Yeah, so we operate in the US-India corridor. So a lot of the companies that we are investing in, it's all Indian companies, but they are either building for India or they're building for the world, and therefore they look at the US. I guess where you raise funds from, you need to think about in terms of what makes sense for your company from a strategic perspective. 5-6 years ago, there was a lot of companies that were just flipping to the US because Y Combinator told them to do that, but their market is in India, so it creates a mess. So today, I think if your market is in the US, obviously you want to stay close to their customers, and coming to the US, you can raise a lot more funding than in India. But at the same time, Indian market has also evolved a lot. Like there's a lot more depth and capital availability and a lot of new funds that have come. So it really, I would say, think about what kind of company you're building, where your customers are, and from a strategic, it has to make strategic sense in terms of whether you're racing in India or US.
I'll let you, have the last word, Prem.
Right. So focus on your value proposition. Valuation is a function of your value proposition. That's number one. The realistic fact is, in India, with venture capital being for the last 20 odd years, the total number of companies that have actually got funding is roughly about 15,000 to 20,000. So we investors have the task of actually identifying good companies with a great value proposition. It is our task to find you. So when your value proposition is really, really good, you will be spotted. You become the magnet to attract people like us to come and give you funding. I'll end with one simple example. One of our portfolio companies, as Arjun was saying, they didn't care about the valuation. The initial valuation of the company was $1.2 million 2 years ago. Today, we're helping them raise $85 million. That's the next round. So, right proposition, global ambitions, right thesis, you will attract the right investors. Thank you.
Great, thank you very much, Vinod, Arjun, Prem, and Ohira for giving, I think, very good inputs to this audience. If you want to talk to them, I think they may be here for the next few minutes. Thank you very much. I'll hand you back to the compere.